Welcome, everybody. Thank you very much for joining us. Tonight is going to be a very exciting night. We've got a great topic. This topic came from lots of people asking us questions, and we don't always have all the answers. So one of the things we do is we've got a lot of experts that we work with, we depend on. We thank you very much, Bill, for coming. Bill's awesome. I've heard him speak at a couple of other events before. And he also works a lot with Massive Capital. So tonight we're going to have a much shorter presentation period because we think it's going to be really important for a Q&A period. And we're going to do our best to give legal advice. Normally we state that we're not lawyers, accountants, or anything, but we do have an accountant in the room. But we'll let him do his own disclosure that I'm sure everything is a lot dependent on your personal situation. But tonight we really want to focus on the fact that real estate investing is one of the most effective tax strategies that you can use to protect your money. It's not how much money you make, it's how much money you keep that matters. And so we're going to talk a lot about that tonight. Again, feel free to share your contact in the information. We are going to have Q&A at the end, but if you want to make sure you don't forget, you can feel free to put your question in the chat so that we make sure that we get to it. And again, as I mentioned, feel free to put your contact info. We want to make this as interactive as possible. So with that, I'm going to turn it over to my co-host, Miss Jasmine. And then Mike will start some of the introduction.
Awesome. Thank you so much, Trevor. That was a good intro. So yeah, we're excited for today. Of course, we're going to be talking about tax strategies and what we have been doing personally. And of course, we will get advice from Bill. So that's going to be amazing. And then we're going to go over a little bit a study case, how your money will look like if you invest in one of our deals, so you can have more clarity. When I talk to investors, I like to show the numbers, I like to share my screen, so it's easier to understand an illustration of your money, but it's more important to understand the tax benefits. So that's going to be a great session right there. And after that, we will open it for Q&A. I know you guys have a lot of questions. Everybody has been waiting for Bill. So let's get it started. I'm going to start introducing Massive Capital. If this is the first time that you join one of our webinars, put new in the chat so we can reach out to you. In the meantime, I'm going to introduce you to our team. On the left side, you will see the three principals. Sanjay, Sharar, and Mike Bailey, very successful backgrounds in corporate, but now decided to go full-time in multifamily real estate. Together, they have over 30 years combined in real estate, doing commercial land, single family, multifamily, and we are excited we started Massive Capital last year. We closed on 880 units, so that was a lot of work, but also very, very good for all of us. This year, we also added Trevor, myself, Maria, and Candace on investor relations. We have Brad Pickett on acquisitions. If you want to submit your deal, if you want to partner up with Massive Capital, Brad will be your point of contact. On acquisitions and finance, we have Ramesh and Bhaskar, and Jen works on asset manager directly with Sanjay. We also have Angela as the chief of staff, Jonathan as our legal counsel, because we need as a good CPA, and we also need a good lawyer. Actually, and lastly, we just launched our education program, and Senate is leading that part. So super excited for that. Our team is growing, and hopefully we can take more deals for you guys. And this is your part, Trevor.
So this is over to Mike.
Oh, okay. Sorry, Mike.
That's okay.
Oh, okay. I was gonna go ahead. Okay, sorry. I was trying to get some people. There were people looking for the link. I was trying to get the link out to some people for so yeah, as massive capital, grows, there's a number of ways and skill sets across the real estate supply chain, and how people get can make money with different, basically in land, all the way across the into property development. We primarily work in two areas, which is to the right is our initial primary area, which is around building operations and building renovation. Not mean that we're in the building those, but it's operating the buildings and renovating buildings, which is basically value add opportunities. And those are our main two core areas where massive capital has grown primarily. We also work a little bit to the left of that, and we've started doing this year in the direction of land development and building development. And in that case, we come in with our core areas of the balance sheet and capital and operations, and then we've been partnering up with some land, with developers in the right space to help us, move up that path as well. So those are the two key areas that we continue to grow in and bring value to our communities, and hopefully to all, and expectedly to all our investors. So thank you. Go ahead.
Awesome. Thank you, Mike. This is the deals that we closed last year. So actually this is 2023. They changed the presentation, but these are some deals that we are doing this year, and the markets that we are currently in. Of course, Texas, Houston, Dallas, San Antonio, Colorado. We are actually expanding our properties in Colorado, Georgia, Macon, Georgia, Warner Robins, North Carolina, and we're looking to enter Florida and Arizona. So those are some markets that we are in and the deals that we're working on this year. Okay, so let's get it started. Bill, please introduce yourself, and we're gonna be asking you some questions, but yeah, take it over, please.
Yeah, sure, thanks for having me on here. So I'm Bill Pilkington. I am the tax partner with Seth and Alexander. Basically, typical CPA firm, we help a lot of people, but really what I like to specialize in is in the real estate market. We do single family, we do commercial, but a lot of multifamily. So a lot of real estate, both on the investor, the lead side, and then a lot of the passive investors. But to tell you the truth, the IRS, they're like our marketing department. Everybody has to file a tax return. So we take care of those in the spring, but what I really like doing is talking with the people during the year, kind of seeing what it looks like from their side of the table, helping them make decisions. Because so many things in the real estate signed often, like I kind of say, like defer, die. So what can we do to defer the taxes, increase current cash flow? And it's different whether they're the lead investor or they're going to be the passive investor. Both of them have benefits, they're just different. And it's kind of like, I like to say also, I'm bilingual. I speak tax and human, because most CPAs, they're just like, hey, just give me the stuff and I'll send it back to you. But and maybe it's because also so I invest in myself too. So especially in like the multifamily, and so I get it. It's like I remember from before when I used to be a CPA before, and we used to be things like, okay, you should try to spread your investments out so when they sell, and then you can ladder them. And then when I started investing myself, I was like, wait a minute, I may not get my distributions for anywhere from 3 months to 5 quarters from now. Invest. Work a lot. So we're based in Texas, but we work things all over the US. We take foreign investors, but I don't do any returns outside of the USA, but we do work with people from outside the USA investing in the States. I'm pretty good. I know we're going to do the question and answer session. If there's something specific somebody wants to know, let us know, but you can ask me pretty much anything you want.
Sure. So actually, we're gonna start like on the high level. At the beginning, we're gonna go wider, and then we're gonna go deeper. So, you mentioned the tax benefits on a real estate professional and versus a W-2 job, right? A
Correct.
person who has a W-2 job. So, can you touch on both of them? You know, what qualifies a professional real estate investor and benefits on both? Because so many
Yep.
of our investors have a W-2 job.
Yes. And actually, it's something a lot of other even CPAs don't always get right. There's real estate professional, but what you're really looking for is what's going to be called real estate professional with active participation. So to be a real estate professional, you have to work 750 hours a year minimum in a real property trade or business. Some people think that's being a real estate agent. That is one of them, but actually, if you own a construction company, you could have a landscaping company, you could have a remodeling company. It does not include lenders. So people that are loaning money to the real estate, it doesn't include them, but it does include lawyers, CPAs that work with real estate clients. So as long as your primary occupation, meaning one more hour than half of all you do, at a minimum of 750 hours a year, that'll put you in the category of the real estate professional. But in order to take benefit of the real estate losses through LLCs or other type of investments, you also want to be able to have 500 hours of active management, meaning things where you sign the front of the check, not the back of the check. So the nice part is those 500 hours can be acquired when you're married through both spouses. They don't have to only be on one taxpayer. The 750, that does fall on the shoulders of one specific taxpayer. But the 500 in a married couple, that can actually be split between the two. So that kind of helps out there. It could be things like, again, like reviewing contracts, approving vendors, approving the rent roll, reviewing your financial statements, the kind of things that only an owner can do. The benefit of that is when you qualify as a real estate professional with active participation, if you are participating in other syndications as a passive, you can aggregate all your activities together and take advantage of the losses that are generated from so many of these real estate partnerships. Losses, and I say loss, it doesn't mean it's going down in value or cash loss, tax losses. With the W-2 employee, they're a little different. They're really going to be looking for increasing cash flow for no increase in tax. So a typical passive investor is not going to see the immediate tax benefits, meaning if you invest in 5 or 6 deals and they're all generating losses, but you have a job something else, your spouse has a job doing something else, those losses are going to be considered passive activity losses. What that means is they're basically held behind glass, and the glass says break in case of profits. So they're not gone, they're not, lost, they're held in a bank. And then that bank of losses is preserved for future gains. Like say, for example, you're in 5 deals, and each one of those deals is carrying a 20,000 loss. So you have collectively 5 times 20 is 100,000 worth of losses that you've not been able to deduct. And one of your profits sells, one of your properties sells, and it has a gain of $60,000. So the first one, the 60,000, and each one, if they had 20, you take the 20 from the first one. So your 60,000 gain now goes down to only having to pay tax on 40. But because you still have 4 other deals and each one of them is carrying 20 each, you take 10 away from each of those, you pay no tax on the gain, and you get to move forward. Again, increase in cash flow. And that's if you walk away. Most of my clients end up reinvesting into another deal. And again, they're able to continue to receive the cash flow and defer the tax. Not the same thing as tax-free, but even with that, there is we'll call it a tax-free. Not my first way to do tax planning, But if you're married, or even if you're single and you die, well, somebody else is going to inherit it tax-free. So no, I say that 1 out of every 1 people die. So it's going to happen. It's just not our primary way of tax planning.
Okay, that's awesome.
So one thing I want to clarify, though, that I say to make sure that I'm saying it right. In theory, if you are a very smart passive investor, you've got your depreciation losses, you keep your depreciation losses. In theory, you will be earning this passive income almost, if not entirely, tax-free because of those losses, correct?
It's
Close
so
to,
I get
not completely.
I get hung up in CPA lingo. When I say tax-free, I mean no way you're ever paying tax, no way whatsoever. It is possible it's tax-free. Now, in the immediate sense, and because sometimes I get called out on it, and what I get says like, so I received this cash, especially if we do like say a cash out refinance, or they're getting distributions from the profits. In that immediate year, you're not paying tax. Those are a lot like getting an advance on a paycheck. It's not going to cost you tax now, but it could cost tax down the road. And I say that if you were to eventually cash out of all your deals and not reinvest into new real estate and just say, you know what, I had a good run, give me all my profits, well then yeah, at that point, the bill could come due. Now, taxes are still less than 100%, and you're only paying tax when you have an actual profit. But what'll happen is we get to front load the losses, and we get to share the losses among properties. So as a passive, you have a pool of these losses, they're carried forward on your return. And then now when you sell, if it sells with a loss, you get to recognize that. But the nice part is the passive losses that are carrying forward, when a deal sells, kind of like we talked about the 5 and they had the $60,000 profit, those losses are freed up, and those losses offset ordinary income. However, your gains on the sale might be considered long-term capital gains. So let me explain. So in that example, the 60,000 worth of losses, if you are in the 30% bracket, well, 60,000 of W-2 income in the 30% bracket equals 18,000 of tax. So we're going to free up 60,000 of losses, and that's going to save you $18,000 of taxes. Now, a normal person would say, okay, but I had 60,000 of gain offset with 60,000 of losses. It's a wash, right? Now, here's where it comes. Those 60,000 of gains, they may only get hit at an average of say 20% tax. So that's 12,000 of tax on the gain, but your 60 of losses are saving you 18 against your W-2. So you actually are coming out $6,000 ahead, even though it looks like it's a zero, a wash, because not all income and not all losses are created equal in the eyes of the IRS.
That's awesome.
And again, it's one of those benefits. Again, you know, and even like a lot of these depreciation benefits, what we're doing, we're not even, or if they're taking accelerated depreciation, it's not creating a new expense. It's stuff that you're entitled to. We just don't want to wait 27 years or 39 years to get it. We're going to use the time value of money to take deductions in the current year or over, you know, maybe the next 3-5 years, accelerate those benefits, get the time value of money to save oftentimes early on the taxes or increase our cash flow early to get into more of those deals. And the more deals you're in will actually end up preserving the benefit for longer into the future.
Awesome. So one of the things that when I talk to a lot of investors, and a lot of investors, their accountants don't understand, or their financial advisors don't understand. And it's quite shocking when you consider that these are professionals and they don't understand. What should someone do other than hire you or someone, an accountant who speaks human? What do you do? Like, how can our people get through that?
So my recommendation is often, to talk to the people, ask those professionals if they invest themselves. Again, kind of see perspective and talk to other members on their experience as to what it's been. It is no, I don't hold all the keys. I mean, believe it or not, all CPAs, we all follow the same rules. There's like 3 or 4 software and we all file to the same IRS. I happen to enjoy this field. If you were to ask me to do taxes on a restaurant, I would refer you to somebody else. If you were doing, or like, car dealerships, buy here, sell here, I would refer you to somebody else. So just because I'm a CPA doesn't mean I know it all. Much like brain surgeons are phenomenal, but I'm probably not going to go to one of them if I'm having problems with my prostate. You're going to go to a different specialist. So find out if that CPA actually understands real estate. Financial advisors, sometimes, I hate to say it, they're just not qualified. They're not qualified to answer questions on real estate. They don't understand how you can use the power of leveraging to actually double money by only making, if the overall property, it earns 20%, but the passive investors double their money, they can't put their heads around it. Some of them, some are phenomenal. I actually have some I've worked with. They're great. They get it. And they're not only looking for assets under management. The problem is sometimes they don't like real estate because they can't figure out how to charge for it. Yeah. Which I get, but it's kind of they should just let the clients know, hey, you know what? I'm probably not the best person. I'm not qualified. Whereas other ones, they're interested, and I've got a few I work with, they're talking stuff. Okay, so what is the client's tax flow? What's their cash flow going to look like? Okay, what taxes will they owe on this? When are they looking at selling? Okay, if they have these gains, they bring this cash in. And they actually understand what it's all about. And they charge a fee for their service, completely fine. The clients can make the decision if, paying this fee is worth it. And they will also sometimes manage stocks, bonds, other things along those lines. But they get it. The ones that are purely looking for, how do I get a fee for assets under management? Or if they don't own real estate themselves, I would, a real estate investor probably might be better served. It's like, okay, maybe you want to use them for only if you're investing, with the traditional ways, but they're probably not going to be the best fit.
Awesome.
That's awesome, Bill. And you recommend some of your some of your clients invest in multifamily real estate. Why do you do that?
So I honest answer is, since the beginning of time, okay, people were in caves. They needed something. They get more people. They need to get a bigger cave. Communities got together to protect themselves from the dinosaurs. So what do? They put their caves together. As they started going out harvesting, what do? They start putting villages together. So they're always looking for some type of housing. You look at things, and as populations have grown, there's almost always been some type of need for housing. It's one of man's basic needs, is for shelter. So the need for multifamily housing, it's going to be here. It's been here since the beginning of time. The method has changed, but it's still going to be there. With like, say, the Great Resignation, going through with COVID. Actually, COVID, if anything, may have stuck people more to look for good housing, good multifamily housing where they can work from home. Commercial is good. There's all sorts of good things, but it's just kind of one of those. I like the multifamily. I understand it. I can see that it's turning. They can make their profits. Depending on the state they're in, there's sometimes state issues, federal issues. But somebody, when the lead investor knows what they're doing, it's sometimes kind of hard to mess it up. Now, okay, I'm not the lead investor. I would mess it up. I invest passively. And so all I look for is, hey, do you got my bank account? Okay, when do I get my first check? We're good. I totally, appreciate good lead investors that know what they're doing. And then where I come in and my play is like, okay, so how do we make your crystal ball a little more clear? What does this mean to me in terms of taxes?
That's awesome. And actually that leads to my second question, because you actually send some of your clients to Massive Capital and they have invested in some of several of our deals. So why do you send them to Massive Capital?
So to tell you the truth, it was after talking with Mike, Sanjay, Schreier, and seeing what their visions were, seeing that they were looking to not just manage money, but get involved in the communities as they go in and they take these properties over. They're actually looking to make the residents' lives better. I see that, what they were looking to do, that they were trying to improve the properties. And then also they had a good game plan going of like, look, we're going to come in, we're going to take care of these. We're looking for properties. They've turned down properties because the inspection didn't work out right or the price point was not right. So they're looking for two things. They're looking to make the residents' lives better, but they're at the same time looking to turn a profit for the investors. So I liked their business plan. I liked their outlook. I like that they also were not trying to do everything themselves, that they will often partner up with local people from other areas that might have a better insight and might have a better thumb on the pulse. And so they were willing to look at other options to get everyone to benefit.
Awesome, that was great. Thank you, Trevor. Before we go to our the second part of our talk today, do you want to add anything, ask anything else?
Yeah, no, there is one quick question, and while this isn't a self-directed IRA or retirement funds, when you do invest with your retirement funds, the depreciation factors do not apply, correct? Because you can't get, in theory, a double tax saving, if I'm correct.
Correct. For the most part, they don't apply. So it's kind of like if you think of an IRA like a bus. So you put money into your IRA or into your, 401k, whatever. And so it gets on the bus and the bus starts driving. You might even switch seats while it's on there. You might be selling and buying different properties, going to different things along the way. When you get off the bus, as the money comes out, you're paying tax on it. Or in the, a Roth IRA, if you had it for the 5 years, you're more than 59 and a half, then there's no tax. So it's more of a cash in, cash out as far as income taxes go. So depreciation is not relevant in terms of IRA investments. Now, the thing you do need to be aware of, and this is not saying they're bad, using self-directed IRAs for real estate is completely fine, completely legal to invest passively, and it's also a good idea. It's just not completely tax-free. Because the cash portion, correct, that's passive. When it makes a profit, the profits on the cash you invest in real estate, you will not pay tax on. But to the extent if a property is leveraged, meaning it carries a mortgage, there is a tax on the portion of profits that are earned from the mortgage. So, for example, say buy a property for $10 million with $5 million worth of loan, so 50% mortgaged, and double the money. So on your money, your profits, half of your profits, because half of your profits were from your cash and half of your profits were from the mortgage, half of your profits will be subject to a 20% tax. It's called, well, the tax rate is UBIT, but it's based on UDFI. Now, UBIT is unrelated business income tax. UDFI is unrelated debt financed income. I guarantee if you Google search IRA passive investments, it will say it is not subject to UBIT. 100% correct. But that refers to the cash portion. The mortgage portion, the debt financed portion, the UDFI is what the tax is based on. That's with self-directed IRAs. And it's if it has the letters IRA in it, it doesn't matter if it's Roth, if it's SEP, if it's pre-tax, if it's beneficiary, inherited. The fact that it says IRA, it's subject to that tax. 401ks, on the other hand, specifically exempt from that tax. So if someone is eligible, a 401k often is a better alternative, but not everybody is eligible for the 401k. So you can't just open a 401k because you want to avoid the tax. There has to be reasons behind it.
Right. Yeah.
Again, don't forget, I'm talking tax on profits. So all it means is your profits, you may only recognize 80% of the profit from the leveraged portion instead of 100. It's still a profit.
Yeah. And it's still something that you have the option to buy a real asset. And normally, if your retirement funds are managed by somebody else, they're super fee heavy, super dependent on the fluctuations of stock markets and everything versus investing in real hard assets.
And I think it's one of those, the individual, if it's appropriate for that individual, if it matches their risk profile, if it's appropriate for the person to invest in the real estate, it's completely fine to use a self-directed IRA. I just don't want somebody to have the V8 moment of like, I didn't know I was going to have to pay tax. And now the tax comes out of the IRA. It does not come out of their pocket. And it files a tax form called a 990-T, Tango. So again, it's ultimately like a cash on cash return is how you determine what the tax is. There's different formulas, but at the end of the day, it's based on that. It's also, if you remember when I talked about my example, the 5 that they shared losses.
Yes.
Within IRAs, they don't. Each one is siloed. So there's no 1031 within an IRA. There's no sharing of losses. Each IRA stands on its own. And effectively, if you get more money out of it than you put into it, and if the reason you get more money out is because there was a mortgage on it, there will be a tax based on the mortgage.
Awesome. Thank you. Very good.
Oh, sure.
Thank you. So we're gonna go to the second segment of this talk. Like, let's say someone, let me share my screen. Sorry. Okay, so this is, do you want to go over this, Trevor? This is one of the deals that we have, and how, how their money will look like if they invest in this deal.
So I just wanted to say this is a current deal. It is a 506C deal, so we can talk about it publicly here to make sure everybody knows. This is a deal in Fort Worth, Texas, Amberwood Apartments. And we're not really here to present the deal, but what we want to do is have investors understand from a tax point of view what can happen. So for example, on this particular deal, it's a 5-year deal. We're buying a 62 unit. Our internal rate of return is estimated to be a little over 17%. Our return over 5 years is about a 1.95 multiple. Average cash on cash. This particular deal has a pref payment. So to make sure that people understand what that means is the first 7% of all profits get paid to the investors before the sponsors or general partners make any money. There is a split on this money once we get past the preferred. It's at 70-30. And then if we exceed the 17% expectation, it goes to a 50-50. Split. So I just wanted to make sure this is kind of the premise of the beginning of this deal. And then if we go to the next slide, what we sort of wanted to talk about. So on the left is just our uses and sources of money. But one of the things that we wanted to talk about a little bit and ask some questions on and have you clarify. So if a person put $100,000 in this deal, first of all, we're doing bonus depreciation, which this year we know is at 80% versus 100. Don't want to make it too more complicated than it is. But on this particular deal, when you put in $100,000, you will get a year 1 tax loss of anywhere from $50,000 to $60,000 on this particular deal. Okay, that will come in. And then there are some passive losses that happen in year 2, 3, 4, but that's the big one, and that's kind of the big nut. And then if you look at it, this is, we projected the cash flow of this deal. So again, you put your $100,000 in the deal, you're going to get about $2,500 cash flow the first deal, which is pretty small. It's a little 2.5%. And then it starts growing. And then, of course, you have your capital event at the end, because when we sell these properties, that's when the majority of the money is made. And so if you could kind of talk through with your accountant's hat on, what does this mean to somebody? How should they look at it from a tax point of view, and kind of the life cycle of this type of a deal? Because this is very common in value add multifamily. You'll see this slide all the time.
Yep, sounds good. So a couple of things. If we consider this as the one and only investment, so that we're not going to use any of the losses. So the first year, $50,000 to $60,000, on the 100,000, maybe we get the loss. We're going to consider that to stay with this investment through 5 years. What will happen is we create a bank of losses. So your 100,000 may create a 50,000 loss on your taxes. And we're talking for the passive investors, we're not talking about real estate professionals. Cash flow and taxes are not the same thing, but they're not completely different. So what you're looking at is, as you start with that 50,000, and then you start looking at your cash flow. Now there'll be losses, but you're not going to, the 2580, you're not going to pay tax on that. The 6111, not going to pay tax on that. The 8037, again, until you recover more than your 50,000, you're really just, for tax purposes, it's a return of your investment. I understand like how it goes here, sale year 5, return of the 100,000 capital, which for investment purposes is more appropriate to call it that. But for IRS purposes, they're really considering a lot of return of your capital, and you start off at a -50. So until you receive your 50 back, there's no tax. And then even that, they're really looking at until you get your 100 back. So what you're going to be looking at is really no tax for the first 4 years. And then in year 5, so now you've got your cumulative of what you're going to be receiving between your cash flows and return of your original capital, plus the profits from the sale, $95,000 worth of total income. And you can call income capital gain, that's, from the, running the numbers together. Of that, it's going to be the 50,000 will be the recapture of the depreciation. That will get hit at a maximum 25% tax rate. Could be less based on everybody's individual situation, but that'll be the maximum. The reason I say it could be less, these profits and losses, the deal itself is like a spaghetti colander. Gains and losses are the water that flow through the spaghetti colander. Could be hot, could be cold. They each flow out to the individual investors. And so one investor might be at a 15% tax bracket, and one investor might be at a 37. They could both receive the same amount of income or loss, but how it ultimately hits them will be based on their individual personal situation. But with the depreciation recapture, everybody gets hit for a maximum 25% tax. And then on the additional 35,000 or 45,000, we're looking at profit. That could be your long-term capital gain. So in year 5, you could be looking at taxes on $95,000 because that's when all the gains come due. And if you close out the investment and do nothing else, you'll pay tax on $95,000. Probably be somewhere in the neighborhood of $17,000 worth of tax. If, however, in the year it sells, you decide to redeploy that capital into a new deal, that new deal creates a new loss. And if that new loss exceeds the 95,000 of the gain on the previous one, you kick the tax can down the road. So you're able to utilize your losses from the second deal to offset the gains on the first. we call that a lazy 1031 because we don't go through the formal process of doing a 1031. Sorry, a 1031 is where you barter, you exchange one property for another. So instead of selling, recognizing the income, and then, you know, transferring it into another one, it's a way to, the lazy 1031 is, you're right, I'm going to pick up the income on one, but then I'm going to pick up the losses on another. And so we get to keep deferring down the road. That's if this is your one and only deal. If somebody is in another deal, year one, we get that 50,000 of loss, but they sold a second property and that other property had, say, a $40,000 gain. They're not paying tax on that second property because we're going to use the losses from this deal to offset their gains on the other. So that's why it's often sometimes beneficial. Sometimes these properties that get purchased at the end of the year, those losses are able to use for the entire calendar year. Whereas the gains they may have gotten January or February, it's okay. We can use one to offset the other as long as it's based on the same calendar year.
Awesome. Very good. And one of the things I want to point out, that was a great explanation, but when you're talking to us investor relations or talking to sponsors of deals, and we'll say, you need to ask your accountant because everything is slightly different based on where you are. That was a good explanation of why there is no one answer, right? Because everybody's situation is very unique. Deals and the way they're structured are somewhat unique. And then let's talk a little bit about the power of investing in more than one deal. And you sort of touched on it, but you know, when I first started, I invested, and my goal was just to get in a couple of deals, and then I started realizing the power. And you know, personally, I moved all of my money into real estate investing. I've invested in 21 deals because of the overall power that it's providing to my tax situation.
Yep. And so I kind of like people that work out at the gyms may have a better understanding of this. If all you do is work on your arms might be really good, but you're losing other things out. If you work on your core, you work on your legs, you work on your abs, owning multiple investments is going to be a lot like having worked out on separate parts of your body. You never necessarily know when one deal is going to sell. So by having multiple investments, when one does sell, you're protected because the losses from the other can help offset those gains. So for example, if you only have one deal and that deal sells December 31st, you don't have any time to buy a new one. You don't have any time to offset the gains from that deal. However, had you been in 2 or 3 other deals that had carried forward losses, selling on December 31st is not as big of a surprise to you because you've got a bank of losses that can cover those profits from the sale. In a perfect world, people sell on January 1st and you get to buy a new property on December 31st. Just understand, if you're buying on December 31st, that means somebody's selling on December 31st. So there's always somebody on the other side of the coin. So that's why I like to have a plan B, because also this number here, this example, very well, I have no idea, I'm just making this up. You guys sell in year 5. But what if like in year 2, somebody offers you all double the money of what you paid for it? Okay, never let the tax tail wag the dog. It's like, go ahead, take those profits. And even, in my opinion, even if you had to pay the tax, remember, tax is still less than 100%. You're getting back more than you put in. It's good. I mean, taxes are not like taxes, but you only pay when you have a profit. What we like to do is say, okay, working within the law, how do we defer when you have to pay them? Maybe avoid them altogether. But, you know, it's not just, well, you made profit, pay a tax. That's not very good advice. It's like, let's look at other alternatives, what we can do. And generally speaking with the real estate, it's by getting into other deals and taking the losses from the other deals. And again, losses are just expenses that you're entitled to. And it's based on, because you bought real estate. It's the principal payments that you owe on it.
So we do have a question in the chat. So we've been talking kind of real estate to real estate. But let's say I had passive losses from this particular real estate deal, but I also had some other investments or notes, other passive income. Are losses like across all of my passive income, or?
Not always. So passive income, or passive losses, sometimes they call it like a PAL, PAL, passive activity loss. And then there's passive income generators, they'll call them pigs. And pigs eat pals. But the thing is, just because you have a loss on something doesn't make it passive. The word sometimes gets thrown out there and it's not always synonymous. For example, interest, dividends, capital gains are often forms of passive income, but not the type of passive income that is considered like with a real estate passive activity. They are slightly different. It also, if somebody has their own real estate, like say they own their own business and they own their own real estate, the rules slightly change as well. With the IRS, it's heads they win, tails you lose. What happens is, I know I said real estate will generate a passive loss. And when you have a loss in owner-occupied real estate, it's considered a passive loss, which means you can't take the deduction. But when you have income in that real estate, it's considered non-passive income. You can't throw a bunch of profits into an owner-occupied real estate and use those profits to offset losses in other investments, which just kind of comes back to every situation's a little bit different.
Awesome. So we've mentioned it a couple of times in the chat, but feel free to put your questions in the chat. We're getting close to the end here, so we want to make sure that we get everybody's questions answered.
Yeah, with that, like everybody's situation slightly different. That's when you want to check. Hey, it's kind of like we sometimes even in stocks, there's things they'll do like stock loss harvesting. So you want to check, okay, hey, if I sell these things at a loss, what can I offset? If I sell these at a profit, do I have something that can offset them? So again, you should be able to have that relationship with your CPA, that you're not just mailing them the stuff once a year in the springtime. In all fairness to the CPA, they can't help you if you only send to them once a year in the springtime. So you want a CPA that wants to deal with you during the year, and you want to be able to talk with your CPA during the year as well. I love talking to my clients. It's like they're almost like friends first and clients second. But working with them, getting a good understanding, and again, if they've got a good financial advisor that understands it, man, that's gold for me. I love working with good financial advisors. There's one in particular I work with, and the clients are on this call too, so they'll know exactly who I'm talking about. He gets it. He understands cash flow. He actually reaches out to me. But to tell you the truth, out of the 1,000 clients I have, 3 of them have financial advisors that actually reach out to me and ask questions. It's amazing. I have no idea how they make their decisions. It's like they do it in a vacuum. And so good financial advisors are not competitors to me. They're, definitely, I like working with them.
That's awesome. So Maria, we just have maybe those last couple of slides, and then we'll do the raise in hand Q&A, and we do have one more Q&A in the chat. We just have, I want to get done doing the slides to make sure that we don't forget it.
Yeah, I'm Jasmine.
So sorry. I do this all the time. I talk to Maria and Jasmine. By the way, their new nickname is Trevor's Angels, because they save me, but I keep messing them up. So I'm so sorry.
It's because I look more like Maria, and Maria looks more like Jasmine.
Yeah, sorry about that. So before we wind this down, we do want to mention to everybody that we do have a couple of deals. We just launched X-Space, which is a 506C deal in Houston. I also put in the chat just a little quick YouTube video. We can watch it maybe in that party. It's just a minute long. It just kind of tells us that. And then we do have 506B deals coming up. But again, you have to have a relationship with Massive Capital. So if you're interested in doing those investments, you need to make sure that you reach out to somebody in Massive Capital. We've all added our contact information in the chat. So just to make sure, and then maybe we'll just let Shrar have a couple of seconds to say hi because he came a bit late, and then we'll take your question, Robert. Thank you so much for being patient. Oh, we had one other question in the chat too before I lose. What types of investments are the best ones to consider? Because we all think it's real estate for passive losses, but we're going to let you answer that.
My answer. Oh, I'm sorry. Who are you asking?
Bill, go for it.
Yeah, sorry, Bill.
My answer, the ones that are appropriate for you. I know that's kind of a cop out, but it's there really is no best. I mean, somebody that wants 20% return with no risk, all upside and tax-free. Okay, well, I bought all those last week. They're all gone. So they're just not out there. So it's really on an individual situation, which sometimes I talk about things like being an accredited investor means you have a lot of money, or either you have a lot of assets or you made a lot of money. Sometimes sophisticated investors are way better as far as comes to investing than accredited. Accredited doesn't mean you actually know what you're doing. I highly recommend people understand what they're getting into. Real estate's awesome. It's wonderful. You just want to understand what you're getting into. And again, investing in Texas, Florida, Tennessee, the non-income tax states, it's a little bit easier. If you start going off into some of these other states with income taxes, it's not bad. It's just different. You just want to understand what you're getting into. And because I don't like people saying, well, I didn't know that. Well, did you ask? And it's kind of like, it's just kind of questions you want to make sure, hey, what am I getting into? What are some things I'm thinking about? And again, the taxes, even in like income tax states, Georgia, y'all are looking at exploring out into Arizona. They're there, but oftentimes what happens is they maybe have like a better cash flow because they're not having the same type of utility costs, the same property taxes, or the same insurance because the states are getting their money through the income tax. Or if you're an investor that's outside of Texas, Florida, Tennessee, y'all are probably thinking, what's y'all's problem? Of course, there's state income taxes. We've been doing that for years. I've got clients up in Minnesota and they understand it. And so for them, they're going to offset one state or the other. So it's back to my original answer, which one's the best? The one that's most appropriate for you based on your situation.
Awesome. Shrar, you want to just say hi to everybody and then we'll go to Robert's question and any others.
Hey, sorry I came in late. I had another call. Please continue. Big conversation. I mean, I'm a finance guy. For me, it's everybody should have a balanced portfolio, right? And depending on who we are, what we're trying to do, risk tolerance, bunch of other stuff, right? Me personally, I have my 401k, I have my Roth IRA, and I took every money out from the stock market and I rolled into the, within the real estate, and we simulated the risk pattern from the equity market, at least for my portfolio in the real estate, across the geographical location, across the asset class, and different verticals of it. So it's an interesting way we can mimic a version of risk tolerance in the stock market within the real estate, as long as we keep on playing with different kind of assets. That's all. Back to you, Trevor.
All right, awesome. Robert, thanks for being so patient, sir. Good to see you again.
See you. Everyone hear me okay?
Yes.
Outstanding. Bill, thank you so much for being here. Massive Capital, you're always doing a great job every week. So thank you to you too. My questions, a series of questions relate to the active income side of things.
Yes.
So W-2, full-time W-2, who wants to be the liquidity partner on a GP team. Have you seen cases where they can earn active income playing that role? I'm sure it gets down to the documents that are signed, but is that an option for a full-time W-2? Does that get to that 500 hours?
So what I've seen, some come in, but they may not be able to take advantage of the tax losses. So it's kind of more like investing in another partnership for the individual. Now, what we've done then is like, in a case of a married couple, it's like, okay, will the married couple, can the spouse take on that role? Again, so it's, having, for lack of a better term, one spouse has to be working in the real property trade or business, construction, property management, asset acquisition. They have to be doing it, to earn a profit. So the one spouse, and actually I've got several clients, they're high net income, high earners, physicians, different ones. Their spouse ends up being the active real estate professional. Now, it can't be one of those real estate professional, call it the Rhino, real estate in name only. They do have to participate. They do have to do real work, because in the event the IRS asks, they're like, do you actually participate? You can't say, well, no, but I like the losses. It's like, again, now don't forget the losses, it's a timing difference. So when I talk about deferring a lot of these losses, and then when it sells, you can use them to offset down the road. The real estate professionals with the active participation, they're not going to have those losses down the road because they're deducting them today. But the benefit is they're offsetting their current taxes today. They're increasing their cash flow today to increase their portfolio. So have I seen it when someone who has a full-time job or making, and usually it's like if they're earning more than 50, 60,000 a year, they get audited, they get pulled. And so it's one of those, I say, hey, just be aware. And kind of one of those, they're like, well, no, I can work the other ones. I can work more hours and my job. And I was like, okay, so I'm in Houston, we have Jose Altuve. I love him. Or if you're in the New York area, Aaron Judge, it's like, okay, theoretically, he could hit 150 homers. I mean, if he's up to bat 150 times, theoretically, he could hit 150. And it's not going to happen. Theoretically, you could work 80 hours a week. The IRS is not going to believe it's going to happen. And generally speaking, it's going to cost you more to prove what you did was right than you're going to save in the taxes. It's kind of like the juice may not be worth the squeeze. Now, that being said, it could be still valuable. Go ahead and GPN a deal. There's very valid reasons. It's just not for saving taxes. Increased cash flow, increased opportunities, diversification, a second stream of income. I mean, the thing I love most about real estate, I guess one of the best things is taxes are secondary, they're good, but you have to have a second stream of income. If you don't have a way to make income while you sleep, you will work till you die. And so having a second stream of income is huge. It's kind of, some of the stuff, there's somebody, I follow very closely. He, I'll give the credit to him, but he talks about stuff like, again, it's like The Rich Dad, Poor Dad, or the other book, The Richest Man in Babylon. And you have to understand how to make money from something else. And that's what I really like about the real estate. So don't focus on just getting the tax benefits when there's actually a bigger benefit to it, and that's the cash flow.
That's outstanding answer. Thank you, sir. I mean, there's plenty of awesome passive opportunities with massive capital. I was just curious about that particular topic. Thank you.
Yeah. No, it's a good question.
Now, one of the questions was, so for example, our X-Base deal, somebody asked about, X-Base does not come with bonus depreciation, right? Just because it's a different deal. We also, previously to this, we did a land acquisition purchase for entitlement. It didn't come. So often those investments, the offset is, first of all, it's a shorter time frame and it's a higher IRR. So there are other advantages to them, but there are not necessarily those same advantages, other than the money comes to you as capital gains. And could you sort of talk about the benefits of those investments that don't necessarily come with the big depreciation loss?
Yes. So it's one of those, when it sells, first off, you're not going to have to recapture the depreciation. So we talked a little bit about the depreciation. The stuff we take, it comes back could be 25% tax rate on depreciation. Could actually be higher. Some of the bonus stuff, I may have misspoke something. Some bonus depreciation actually can come back at ordinary tax rates. So your recapture of the depreciation might reduce the benefits of the capital gains, meaning so it's not going to be all as capital gain. So by not taking the bonus, you will have probably a lower potential tax bill on the back end. But again, I'm the CPA guy, I get it, taxes, we want to do what we can save taxes, but the bigger picture should be focusing on the gross. Okay, what am I going to return on it? We'll figure out ways to save the tax, but even if taxes, I'm going to make back under, up until Reagan went crazy, Ronald Reagan dropped the tax brackets and, all the way down to 35% or 28%. That's because people forget they were 60, 70%. JFK went crazy and dropped them from 90 to 70. And so, but imagine taxes are 70%, but you only make $1 profit. Okay, 15% tax or 72% tax. If you're only making $1 profit, really not saving taxes, not the big deal. Making the larger profit, making the bigger return is really the bigger prize to focus on. So what I would say is if that one doesn't have the large bonus depreciation, if you're a person that needs these large passive losses to offset passive income, maybe that's not the right investment for you, if that's what you're looking for. But if you're looking for a larger gain or whatever, if it's a value play, if it's a yield play, even within real estate, they're not all created equal. Again, so make sure, why are you buying it? And if you're saying, because in some deals, you are looking for it because you need that big depreciation deduction, because you sold several properties during the year and you need something to offset those gains. Well, then that may not be the appropriate investment for you, is what I would say.
Yeah, and we talked about this a few weeks ago when Paul presented about diversifying your investments. So diversifying by asset class, by timeline, by type of returns, so that you're balanced, right? So if you're all just in one area, you don't create that kind of balance between, because again, X-Base, for example, it's a 2 to 2.5 year, 1 times your multiple of your money. It's a completely different play than the one we talked about earlier, which is your money stays tied up for 5 years and has these other things with it.
Yeah. And I know one of the questions.
Both are good for different reasons. It's the balance of all of them.
Correct. And again, kind of going back again. So as a passive or as the real estate professional, remembering you can be a real estate professional, but you still might be considered a passive investor, because say you're a real estate agent and you work 2,000 hours a year doing only real estate transactions, or you own a construction company, you work 2,000 hours a year working on construction. That will put you in the real estate field. But unless you have the 500 hours of active management, meaning properties you own and control, properties where you sign the front of the check, not the back of the check, GPing a deal. If you're a GP in some of these deals and you're making management decisions. So like the GP in the deal may talk with the LP and they could both spend 3 hours talking about a deal. The GP is going to walk away. Those 3 hours will count towards those 500. As an LP, none of your time qualifies, because as much as LPs can have influence or, talk what they want to do, at the end of the day, they have no authority to bind the deal to something, and therefore none of their hours are considered active participation. So in order to get any of those benefits, you have to have the 500 hours independent of any investment you do in any type of deal.
This has been absolutely awesome. We do have somebody from Oregon that wants to hire you. Probably he's from a high tax state. So, but I don't know if you want to share your contact information or best way for people.
So,
and it's funny when you're talking about where people live, I say, I don't even know why crazy people still live in California, but they do. Because they love
two Californias. There's the fog line, then there's the rest. I've got a lot. Actually, I have a lot of clients in Oregon, and so it's really nice. I mean, actually, it's a beautiful state. Yeah. So I understand totally. They grow some of the, believe it or not, it's like some of the nicest roses you'll ever find come out of Oregon. But yes, so we take them over all 50 states, and probably the best way is to my assistant Valentina, or Val Aguirre, and we can send it up like her email. You can email her, you can call her, you can email her, and just say, hey, I heard Bill on the Massive Capital webinar, and we can make it available for people, you know, however you want. I can get with Jasmine, she can send it out to everybody. I'm horrible at scheduling. So actually the worst way is to ask me to schedule an appointment. I will undoubtedly mess it up. Val is phenomenal. And so she will get the schedules. If you've heard me talk before, Lady was the one that did before. Val and Lady work together. Val is now the one I use for all like new and prospective clients to kind of set things up. And so there's no charge. We'll talk, you know, just kind of talk about your individual situation, kind of see if we can help. And because, you know, everybody's here on the Massive webinar, you know, so it's like, and I won't have a contract for you to sign. There's not going to be any pressure. So it's just going to be truly free. And if you like what we have to offer, we can move to the next level. But I don't want anybody to think like, okay, they're going to, you know, call me and then therefore I'm going to be like, okay, you need to sign up now, sign now. I'm actually probably the anti-salesperson, you know, just because, you know, it's just like, hey, you know, here's what I have to offer and I'm happy to help.
Well, we're certainly glad you remembered this calendar appointment, because this has been absolutely did not disappoint. I told all my friends, if you really want to come and you really want to actually have, I've been to a lot of county presentations and I leave more confused than when I show up. So, you know, and this was very important for us to be able to offer to the people that are, you know, come to our community just to get some really good value. So,
Oh, thanks. I appreciate that.
So much appreciated. And any other questions? I mean, in theory, we're in our happy hour now, but this has been amazing.
Yeah, it went a little bit longer. Now we're in happy hour time. So I'll make sure when we send out the recording, you guys are gonna receive the recording. So many people are asking already about the recording. We're gonna include Valentina's Calendly, and so they can reach out to you and book a call with you through her. So don't worry about that. We will share that with you.
I know you didn't ask it, but I get asked a lot. Should I form an LLC? Should I form a trust? You know, how should I own it? And so generally speaking, I'll say, if you know you need an LLC to protect your assets, then you need one. If you're not sure, you probably don't need one. For taxes, there are different reasons, asset protection. So it's, you know, because these deals usually, unless you're owning real estate in your own name, then generally speaking, the attorneys I'll speak with are like, you don't need to form an LLC. It doesn't hurt to form one. But also the other just sometimes misconception is people say, well, I have a trust. All my stuff's protected. I don't need an LLC. The word trust is kind of like the word car. Ferraris are cars and so are Kias. So they're not exactly the same, you know, but then again, even which one's the best one too. It's kind of like, I could also say, hey, which one's better, a Ferrari or an F-350? Most people are like, well, for Ferrari, of course. It's like, great, because I live on a farm and I need to haul a ton of manure. Oh, wait, maybe the F-350 is better. Everything is relative to what you want to use it for. Generally speaking, you'll see a lot of things that are called revocable trusts, living trusts, family trusts. Those are really more like to put everything under one name. They don't give asset protection, but they are very good tools for estate planning and probate, especially if you're owning things that are out of state. It's able to put everything under one name, under one wrapper. Some people like to use them because, you know, it creates an opportunity for anonymity. So it's another way of saying, like, okay, I wouldn't call it the Trevor Thompson Trust and then think that people aren't going to know who owns it. You know, it's like, you know, think of a really unique name if that's what you're using it for, but don't use it for asset protection. LLCs, limited partnerships. So I'm not the attorney, I just have to deal with a lot of them. And so like Wyoming is quickly becoming it's becoming the new Delaware. That's where a lot of people end up going in forming some of these businesses when they want to create anonymity. I don't form LLCs. I don't create them. I use good attorneys for them. And again, much like we talked about, a good financial advisor, good CPA, if you're doing these things, make sure your attorney also, because don't go to your friend who's an attorney, who's a divorce attorney, or a personal injury lawyer. Fabulous at what they do, but maybe they're not appropriate for creating real estate opportunities. Maybe they're not the right one for estate planning. Maybe they are, but just the fact that they're attorney doesn't make them the right one to use.
I can't believe you told everybody the name of my trust. Awesome. So any other questions folks have? I know we've been going for quite a while here. And again, thank you so much, Bill. This again, way over delivered.
Oh yeah, my
Art,
pleasure.
have any closing comments or
Question for Bill.
anything?
Right. So, hey, so last year we had the last year for 100% depreciation. This year it's 80%, then it goes 60%. When does it go away? Or 60 is the last cutoff? Or if I were to have earned income somewhere else and really need to get into this depreciation game, the way the amount we get today was lower than last year, will be lower next year.
Yep.
How should I plan for it?
So it's a sliding scale, 100, 80, 60, 40, 20, and it goes away unless they change the law. Now, that being said, is it okay if I take a little time to explain what that depreciation really meant?
I think you have time, right? Yeah,
what it did was, it wasn't the entire investment. So of the investments, what the IRS allows for something, it's called cost segregation. And they kind of get to break down the apartments into different parts. Instead of looking at it as just one piece of real estate, it's a mixture of separate parts. Kind of like I can show you one hamburger, or I can tell you 2 all beef patties, special sauce, pickles, cheese, lettuce on a sesame seed bun. You list the different things out. So inside of the apartment, you might have wiring, you might have windows, you might have HVAC units, you've got the parking lot. They break these things down. In a typical apartment, it's residential real estate. The IRS says you could divide the cost, the acquisition price, over 27.5 years. But when they break it out, some of it could be divided. You can recognize the expense over 3 years, 5 years, 7 years, 15 years. So now, again, so 2.7 million, instead of maybe recognizing it 100,000 a year over 27 years, you might be able to do it in 7 years. And so they're looking at taking 400,000 a year for 7 years. What the bonus depreciation says, hey, guess what? Not only can you say you take it in 7, we're going to take it all in year 1. And so instead of taking it over 7 years, you deduct it in 1 year. What the law change was, it was you could take 100% of that 7-year asset in year 1. Now you can take 80%, and the remaining 20 will divide over 7 years. So it's still going to be shorter than 27.5. It's just not going to be all in the first year. And even then, generally speaking, of the entire purchase price, maybe 1/3 of it was coming off the top of being expensed all in the first year. Could be more depending on the property, depending on how it goes, but it was never 100% of the purchase price to be all written off in the first year. A lot of my clients thought that's what it meant. And then we explained, no. So basically the foundation, the studs, the roof, that's still staying 27.5 years. It's the rest of the stuff. How do we get to break it down, what they call personal tangible property or tangible personal property, and take those over a faster, quicker time period? And it all comes back to time value of money.
Thank you.
Thank you, Bill.
Last call for any questions. This was awesome. Thank you for everybody for coming. I want to make sure too, just feel free to invite your friends. We do this every Wednesday night at 6 o'clock. We always try to bring value. This goal of Massive Capital is to help people reach their financial independence through real estate investing. And part of that is educating yourself, right? That is the biggest first step before going into any real estate. And I see Brad here too. He's on the call here. So Brad does a lot of deals, hunting and a lot of things. So I give out Brad's name all the time now. People are saying, got a deal, I got a deal.
Me
So
too.
how many deals have we underwritten so far this year? Staggering. I think he's
Last
frozen.
12 months. Yeah.
I think he's frozen. He's doing his taxes, I think.
We got a question about the Roth IRA. He was like, I'm confused. Then he got another question about the dual life policy, a dual strategy policy on the life insurance. That's some fun stuff. Yeah. So we last 12 months we did 246 assets, I think. Yeah, around 250. Yeah, right around. I calculated today, it's $2.3 billion worth of values that we underwrote, and some way, shape, or form took a look at it. We ended up buying almost 120 or so. So it's an interesting data point. Thanks to Brad, he keeps a tally of that all the
I
time.
know. I saw you post that today, and it was like, wow.
It's a lot. That's a lot. I didn't realize it. It's a lot. Then we have 21 in the pipeline, right? And then we have that. Hey, good work, Brad.
Awesome. Well, Maria, you want to wrap us up? Maria, Jasmine, that's it. You're gonna have to change your name to Jasmine Massive Capital so don't mess it up.
Yeah, I already told Maria, like, do you want to switch? Like, I think it's better for me to be Maria
No.
for you to be Jasmine.
I'm so sorry.
No, I just want to say thank you so much, Bill. That was like drinking for a fire hose. I'm pretty sure so many people are gonna be reaching out to you, and I personally want to thank you because every time that we have questions, you're always available. I appreciate your time and all the golden nuggets, all the knowledge that you just been dropping with us today. So thank you so much again.
Oh yeah, my pleasure.
Waiting for your assistant contact information, and I'll share it on with the recording. And thank you so much for our K1s.
Yep.
And we're excited to receive the new ones.
Yep.
Awesome. Well, good night, everybody. Thank you so much. And we'll see you all next week.
Thanks, cheers.
Thanks.
Take care. Thank you.
Bye-bye.
Thanks, Bill. Hey, Bill, I gotta follow up with him, and I still need to do my whole setup of the structure.
Yeah.
I'm dropping ball on that one. And the tax test coming up, we're already in May. It's like it's gonna slip again. So please,
Yeah,
I'll remind you. So
no, it's good. I don't know if you heard too. I was out in Georgia on vacation.
Okay.
I stopped by one of Mike's properties and took some pictures, waving.
nice. No, I mean on that note, I really gotta set up that one. I'm out of I'll be out of town for a month, but I don't know how the taxation kicks in. S corp, C corp now versus December, that kind of stuff.
Yeah. We're good. We'll go over all those, but yeah, we're still good for now.
Okay, sounds good. Thank you.
All right. Thanks again. Bye.
All right. Thanks,
Good
everybody.
night, everybody.
Good
Thank
night.
you.